Welcome to the deep dive. Today, we are focusing on a project that inspires really fervent dedication and, well, intense skepticism to the Pi network.
That's right.
Our mission today is to cut through some of that noise and synthesize the critical analysis from September 2025. It was quite a month.
Yeah, a high-tension month, definitely.
Yeah.
Defined by, strategic rate cuts, some curious market volatility, and this big push for regulated utility.
Exactly. So for you listening, tracking this ecosystem means trying to reconcile two, well, very different stories happening at the same time.
It does. On one side, you've got the core team implementing these almost draconian scarcity measures, really tightening the screws.
Uh-huh.
But then on the other side, they're attempting to, catapult the project into traditional finance through institutional products.
It's quite the balancing act.
Yeah, and we're going to unpack the details behind that, drawing primarily from recent analysis, looking at the tokenomics shift and that major token movement to OKX.
Okay, let's jump right in then. The core strategy. Engineered scarcity. This affects every single user, right?
Oh.
All 75 million plus of them.
Every single one.
The team keeps aggressively throttling the supply. So can you break down the specific numbers, what actually happened in September?
Certainly. So we saw the continuous adjustment mechanism implement its latest cut. The new basic mining rate dropped again. It fell to a really unprecedented low of 0.0027405 pi per hour.
0.0027. Okay.
Yeah.
That's a 1.23% reduction just in September, but, 0.000027 pi per hour. It sounds a bit abstract.
Yes, yeah.
Let's ground this. For the user who just opens the app, taps the button once a day, no bonuses, nothing extra, what does that rate actually mean for them, practically?
The impact is pretty dramatic, actually. We have to note that this new rate means it now takes the average miner, without boost, more than 15.2 days just to mine a single Pi coin.
15 days, wow.
Yeah, and if you look at that annually, the total return is roughly maybe 24 Pi per year, assuming you mine perfectly every single day.
Over 2 weeks for one coin. And wasn't this after an even bigger cut?
Exactly. This 1.23% cut followed an even sharper 8% reduction back in August. That's when the rate fell to the lowest point since the whole project started back in 2019. It's really collapsing towards zero.
So where's the tipping point here? That's my question.
That's the critical tension, right? The team's justification, what they say, is pretty clear. These continuous adjustments are necessary to maintain a balanced supply, support long-term growth, and, crucially, create scarcity.
Scarcity.
Yeah, the underlying economic idea is that by making new coins super hard to earn, the potential value of all the Pi already mined, held by existing users.
Well, that value should increase.
Okay, but hang on. If you make it so difficult, over 2 weeks for just one coin, doesn't that risk just, demoralizing the huge base of loyal miners?
That's the gamble.
Doesn't that frustration, that feeling of minimal rewards, risk alienating the very community that gave them the network effect in the first place? That is absolutely the risk calculation they're making. They seem to be banking on the idea that existing users, especially those maybe with locked up Pi, will see this scarcity as a guarantee of future value, something that justifies the effort. They're definitely shifting the network, moving from an easy accumulation model towards something much more deflationary, scarcity-driven. It's a bold move, really testing the faith of their users.
Okay, so on one hand, you have this deliberate squeeze on supply, but then the external market forces kick in, specifically this enormous kind of mysterious token transfer. It really injected some drama, didn't it?
Oh, yeah.
Let's talk about that market drama. The
Wow.
OKX mystery.
Right. This is where theory meets market reality, you could say. Sources, including the Times of Pi network, reported a staggering movement. 6.5 million Pi recently transferred directly onto the OKX exchange.
6.5 million tokens. That is a massive block, especially when you think about the strict lockup contracts that supposedly govern most of the supply.
Exactly.
So the immediate question is, who is moving that much coin and why?
And that is the defining mystery here. Because the whole premise involves long-term lockups, right? So this kind of volume suggests one of maybe two things.
Okay.
Either it's a coordinated move by, say, a large whale, or maybe a group of whales who somehow got hold of a massive amount of unlocked Pi, or, and this is maybe more likely given the sheer scale, it's some kind of internal transfer.
Like from the foundation itself?
Could be. Related to the foundation, maybe liquidity provision or some strategic market action. But the team hasn't offered any clarity. And that ambiguity, well, that's exactly what fueled all the speculation and tension.
Right. And ambiguity with large transfers usually leads to one fear. A massive sell-off is coming.
Pretty much.
So what did this influx actually do to the price?
Well, the coin was already feeling some pressure. It had been down, what, more than 3% over the month before?
Yeah.
And it was really struggling to break that crucial $40.40 USD barrier. So yeah, the transfer only added to that downward pressure as the market started anticipating those 6.5 million tokens potentially hitting the order books.
We hear about these price barriers a lot. Why is 40 cents such a critical level? Psychologically, technically.
It really represents a clear line of resistance. It's a point where sellers have repeatedly stepped in and pushed the price back down.
Yeah.
So if it could sustain trading above $40, that would signal more than just a short-term pump. It would suggest confidence, that the project can actually hold higher ground.
Interesting.
But despite that OKX transfer scare, the price actually showed a surprising amount of resilience. It kept trading at a pretty tight range between $33 USD and $43 USD.
Okay, so it didn't just collapse. That support level held up.
It seems to have, yeah. Technical support looks pretty firmly established between about 32 cents and 35 USD, which suggests that, okay, while they're selling pressure up near $40, there's also enough buying interest lower down to kind of absorb it. So the takeaway, I think, is if the network compare these, positive technical signs on the chart with some genuine utility improvements, then breaking through that $40 resistance could really signal the start of something new. A rally, maybe?
That leads us perfectly into the utility side, because like you said, scarcity alone is just artificial restriction. Utility is where the real sustained value comes from.
Absolutely.
So let's shift focus. The big push for ecosystem expansion, starting with the launch of PiNet. What exactly is that?
PiNet is it's a huge strategic initiative for them. It's designed to function as a bridge, basically.
Yeah.
Connecting the traditional Web 2 world, the internet most people use every day, with the decentralized Web 3 application space.
Okay, a bridge. Why is that critical?
It's critical because it aims to make the Pi ecosystem accessible not just to their, crypto-savvy 75 million members, but potentially to anyone using a standard web browser.
So they're trying to onboard the non-crypto folks directly into their apps?
Precisely. PiNet expands the reach of Web 3 applications, and its architecture specifically supports conventional browsers. Think Chrome, Safari, Brave.
The ones everyone uses.
Exactly.
Yeah.
This is a direct shot at solving what's probably the biggest hurdle for most crypto projects: getting true global user engagement beyond the existing crypto bubble, without needing complex wallet setups or specialized knowledge.
Right, meeting people where they already are.
Yeah. They want utility demonstrated right there, where people already spend their time online.
That's a smart way to try and leverage that massive user base they have. Okay, so beyond PiNet, September also brought quite a few institutional and technical wins, it seems, things that suggest a pivot towards more mainstream acceptance.
Yeah, there were several headline developments. 4 major signals, really.
Okay, what were they?
First, accessibility got a big boost. Listing on on-ramp money. That allows direct Pi purchases in over 60 countries. That simplifies the whole on-ramp process quite dramatically.
60 countries. Okay, that's global reach. What about visibility? Legitimacy in the wider crypto world.
Well, they secured a gold sponsorship at Token 2049 in Singapore. That's a major crypto conference, a big deal.
Right.
Getting that kind of sponsorship is a signal of legitimacy, especially with the founder, Nicholas Kokalis, expected to attend and represent the project. It's them stepping out of just the mobile mining app space and onto the, institutional conference circuit.
Okay, moving into the big leagues, so to speak.
Yeah.
Now, what about the technical and financial achievements? You mentioned Protocol version 23.
Yes, they're preparing for Protocol version 23. And this is potentially huge because it's set to integrate KYC functions directly onto the blockchain itself.
Okay, KYC, know your customer on the blockchain. Why is doing it on the blockchain instead of using some third-party service such a big step?
Oh, it's all about trust, security, and, frankly, compliance in a decentralized way. Traditional KYC, often managed by centralized companies, which creates these massive security risks, right? Like a honeypot full of user data waiting to be hacked.
Yeah, that makes sense.
By building KYC directly into the blockchain protocol, they can potentially verify user identity in a more decentralized manner. That could improve privacy and security while still meeting the regulatory demands for accountability. It's pretty much essential if they ever want full open market access without regulatory hurdles.
And speaking of market access, maybe the single biggest piece of news was the ETP.
Ah, yes. The ETP.
For a lot of listeners, ETP is probably still a bit of financial jargon. Can you break that down? What is an exchange-traded product, and why is the launch of the first Pi ETP by Valor on a Swedish stock market such a potential game changer?
Right, so ETP stands for Exchange Traded Product.
Hmm.
The simplest way to think about it is like a regulated investment package.
Okay.
Instead of you, the investor, having to go buy the underlying crypto directly on an exchange, which involves managing wallets, keys, all that stuff.
Which can be complicated or risky for some.
Exactly. Instead, you can buy shares of this ETP through your regular traditional brokerage account, just like you'd buy stock in, say, Apple or Amazon.
Ah, okay. So it basically slots Pi, or at least exposure to Pi, directly into the traditional financial system.
Precisely. It makes it accessible to regulated funds, maybe pension plans, even retail investors who might be restricted by their broker or by regulations from owning crypto directly.
Wow.
The Valor ETP provides regulated exposure. And for a project like Pi, which has, let's be honest, lived mostly in a kind of speculative gray area for a long time,
Definitely.
this move, getting listed on a regulated European stock exchange, is probably the strongest signal of institutional validation they've received so far. It suggests that traditional finance players are starting to see a path toward compliance and maybe future liquidity for Pi.
That really is a powerful duality, isn't it? On one side, extreme internal scarcity being engineered. On the other, this external validation pushed through institutions and regulated products.
It's fascinating to watch.
But let's bring this back down to earth for a moment. Ground the conversation in the actual user experience. Because all this high-level stuff happened alongside some technical hiccups, right? What was going on with the Pi wallet recently?
Yeah, it's the classic tech scale-up irony, isn't it? You score these major institutional wins, and then the app breaks for users.
Happens all the time.
Users started encountering this failed to load mainnet wallet error. Happened right after they tried to log in using their passphrase.
Okay, what caused that? Did the network just buckle under the pressure?
The analysis points pretty clearly to an overwhelming spike in high traffic. Just too many people trying to use it at once.
Any specific reason for the spike?
Yeah, it wasn't random. It seems it was triggered specifically by the launch of a new lockup boost offer.
Ah, so people were rushing to change their settings.
Exactly. Users rushed to adjust their lockup configurations, trying to get that extra mining bonus, and the sheer volume of people trying to access the wallet simultaneously just, well, it overwhelmed the system's infrastructure.
It's interesting, isn't it? A bonus offer designed to increase long-term commitment ends up temporarily crippling basic functionality.
It does kind of undermine the credibility they're trying to build elsewhere when a predictable traffic spike causes access failures for users.
So what was the fix? What did they tell people to do?
Well, the Pi Open mainnet team did respond relatively quickly with some clear, although maybe slightly technical, steps.
Right.
Users were advised to temporarily disable their DNS settings,
Okay.
then retry accessing the wallet. If that worked, restore the DNS settings, and then clear the cache and restart their device.
Standard tech support steps, basically.
Pretty much. Clear communication is good, but yeah, the incident definitely highlighted that their infrastructure might still have some scaling vulnerabilities, especially under peak load.
Okay. So before we wrap this up, let's zoom out one last time. We've got this project launched by Stanford PhDs back in 2019.
Right.
Built on this really simple premise. Easy, ecological mobile mining. Just tap a button once a day.
Yeah, that was the hook, making crypto accessible.
And now, here we are in late 2025, and they're making these aggressive moves towards deflationary economics, traditional finance integration. It's quite an evolution.
The foundation was always about mass adoption, using that simple daily tap. Now, the complexity is whether they can actually transition from that user acquisition model to a value accrual model. Can they convince those 75 million users that their increasingly scarce daily reward is actually worth the ongoing effort?
Yeah. So we've really covered that central tension, haven't we? The deliberate, almost extreme scarcity measures designed to boost theoretical value, running parallel to the immediate market pressure and drama from things like that huge, opaque OKX transfer.
And what's really quite revolutionary about this specific moment, I think, is the simultaneous push for two potentially competing narratives.
Yep.
You've got institutional compliance, signaled by the ETP, and then you have grassroots utility, driven by things like PUNET.
Which leaves us, and you the listener, with the ultimate question to mull over as you watch this unique project evolve. Will the deliberate creation of scarcity, taking more than 15 days now to mine just one coin, will that be successfully offset by the potential utility boost from platforms like PiNet and the legitimacy gained from regulated products like the ETP?
Or Will the persistent lure of immediate liquidity, the market speculation,
Mm.
and those unresolved questions around major token movements, will that ultimately dominate the coin's trajectory?
It's the key question.
It really is. Keep a close eye on the trading volume, for sure, and watch that crucial $40 resistance level. If it can break through and stay above that point in a sustained way, well, that would be the most tangible signal yet that maybe, just maybe, the institutional and utility efforts are finally starting to overcome the market skepticism.
A great challenge and a key level to watch. Thank you for guiding us through all these complexities of Pi Network in September 2025.
Always a pleasure. Thanks for having me.